All right. Hi, everyone. Good evening, everyone, and welcome to tonight's webinar. So, if you guys can hear me, can you just help me to type in 555 in the chat? Let me know you are here. Type in 555 in the chat. So, if you're from Singapore, okay, type in SG. Okay, if you're from Malaysia, type MY. Let's see if we have any audiences from other parts of the country. Fantastic. Let us know. I'm going to look at some of the comments as well. Yes, hi. Wow. I saw an amazing comment. Okay. Okay, let me just introduce. Okay, FN Microwave. I do not know who are you, but I really appreciate that. Okay. Okay, Li Ping from SG. Fantastic. I can see most of you are from SG. Everina from Malaysia, and Kelvin from China. Wow, very interesting. We have a very diverse crowd. So anyway, for those of you who have not seen me before, my name is Borwen. I was on the show previously, I think just last week, right? Last week, I was actually doing the market update together with Chloe. I'm not sure if you guys actually listened to that. If you did not go and listen, if you have not listened, please do go and do so. Okay. In fact, during that particular segment, we shared one company. So if you still remember what was the company that I shared, okay, you can type inside the comment as well. So I think that company has gone up quite a fair bit for those of you who managed to see that opportunity, managed to grab the opportunity, then congratulations. Okay, I think it is a pretty good ROI, all right, for you guys as well. Okay, we just probably going to start in about 1 minute. Okay, let's just wait for about 1 minute for the rest to actually join in. And of course, do help us to like and share. Again, we are doing this every Tuesday. We want to reach out to more people, share more value. And if you guys actually find value in what you are listening over the past few weeks, continue to join us. Okay, continue to join us. And also, do let us know what kind of content that you're also watching out as well. Yes, PDD, that was the company that we shared 2 weeks ago. Okay, 2 weeks ago. And yeah, I still love the company. If you ask me, is it overvalued or not? I think, after the earnings report, people get to see the value. Once people see the value, naturally the share price is going to, go up as well. So that's also something that I'm going to share with all of you later on as well, on how we can actually pick the next 100% company ROI stock. So this is very exciting. Okay, so make sure that you guys actually, share this with your friend. If your friends invested into the stock market, you are not sure how to pick the next 100% ROI company, then you have to listen to this particular episode, okay, this particular webinar. All right, if you have missed it, don't worry, there will still be opportunity. Okay, just continue to follow us. Again, just to share with you that we are not hiding anything. Whatever we know, we literally share with all of you. If I see any good opportunity, okay, I will also share it with all of you tonight as well. Right, but of course, today we have a certain framework and certain things that I've already prepared that I'm going to share with you. Of course, later on, if you guys have any question, feel free to also put it inside the comment as well. So without further ado, I think let's get started. Okay, so for today, this is going to be the topic. We're going to spot the next 100% ROI stock. So if you guys are excited right now, can you type in 100% or type in 100? Wow, I am excited if you guys are not, okay, because when I was actually doing this, I actually share with all of you, okay, the reason behind it. Okay, so some of you will be waiting for the stock tip. So today is not about stock tip. Okay, it's about understanding and finding the pattern. Once you understand and you know exactly how to actually spot it, I can tell you, you can actually go and find many 100% ROI stock. That is actually more important. So let's get started. So of course, for today, okay, I want to start off by asking all of you a very important question. If you want to get the next 100% ROI stock, which market do you think will be easier for you to actually get that? If you think it's SG type SG, if you think it's US type US, what do you think? Which one would be easier for you to get the next 100% ROI stock? So we can see the answer coming in: USA. Anybody type SG? All right, so I'm glad that you guys are typing US. But again, I understand that, again, this webinar is for everyone. So for those of you, if you are only investing into the Singapore market, it's okay. It's okay to type in SG. Okay, but of course, I'm going to share with you why. So the correct answer is, of course, the US lah, but I'm going to just prove it to all of you why. This is the STI. So over the last few years, from 2020 all the way till today, about 3 over years, if I were to take the lowest point, which is during the COVID period, the lowest point, and I compare it with today pricing, you can see that the market, the index overall is up about 45%. Not too bad. Okay, not too bad if you're able to spot and pick the lowest. And in fact, if you realize, since 2021 May, all the way until today, the Singapore market has been stagnant. So over the last 1 year, if you invested into Singapore market and you make money, congratulations, because you are doing better than the index. The index has been flat since 2021 May. So 2 years, you sit down there every day, look at the screen. That's why don't need, if you invest, don't look at your platform. Imagine you look at it for 2 years and the price didn't move. Then I am sure you will lose faith. Okay, or at least if you want to watch, choose the correct market to watch. So this is the US market 2020, right at the bottom. Wow, see, you can see actually it's supposed to be right at the bottom. Okay, all the way until today, it is up about 100 and, wow, this is a bit blur, 105%. Okay, again, not too bad, 105%, which is 100, which is 1 times double. Right, but most importantly, you can see that the movement is a lot bigger. Okay, the movement is actually a lot bigger. And in fact, for those of you who managed to actually capture and buy some of the company over the last 1 year, okay, you can see that the market has also went up quite significantly over the last 1 year. So there is definitely more opportunity. Again, when the market is flat, it also means that it's harder for you to pick super undervalued company, or what we call hidden gem. Right, in the case of the US market, because the fluctuation is a lot bigger, so when the market starts dropping, if you are able to identify which are the next 100% ROI company, during such opportunity, you go and grab it, and then when it recover, that's where you can actually get your first one bagger, which is your first 100%. Now let's move on. Okay, this one I think you all already answered, right? The US market, after looking at the Singapore versus US, obviously is the US. So I want to still showcase what happened if, let's say, today I'm invested into the Singapore market. Does it mean that I got no chance to find company that makes me a lot of money? Right, again, you can see that this company is called iFast, a Singapore listed company. If you have heard of this company before, type me in the comment. Right, so again, this company back in 2020 was trading about $1 plus, and then post-COVID, it shoot up all the way to about $10. Even at the current pricing of $5, you can see that if you bought it at a low price, you will still be making at least 3 to 4 times, or maybe 5 times. So that is still amazing return, right? Just now you can see that the Singapore market average is only 40 over percent, but this is like 400 over percent. So there will be this kind of outlier. But the thing is, how many of us can pick this kind of company? Or rather, how would you know that why this company actually increased in prices? I think that's something that we want to understand, right? So the question here is, do you know why iFast share price gone up so much? If you know why, type yes. If you do not know why, type no. Again, today, the whole sharing, I will try to keep it as fundamental as possible. That means anybody that is totally new, right, you will be able to understand. I'm not going to use very complicated jargon to confuse you guys. So most of you actually type no, some put maybe. Very simple. Let me just share with all of you. If you look at this is the earnings and revenue history of iFast. Right, so basically the blue color line is the revenue. Okay, revenue definitely more than earnings. And the green color line is the earnings. Okay, blue is revenue, the green is earnings. So very importantly, you can see, okay, this one maybe not so obvious. You can see very obvious the revenue has gone up. But in fact, the earnings has also gone up over the years. So if I were to just zoom in to share with all of you, back in 2018, this company revenue is 121 million, earnings is 10 million. Okay, so 2021 December, revenue reached 200 million, about double. But the earnings actually went up 3 times. Okay, earnings went up 3 times. Okay, some of you say hang. Okay, I hope it's not hang. Okay, because I can still see some of your comment coming in. All right, so again, why the share price actually gone up so much is because the business is doing way better. All right, so that is also the reason why we always ask you guys, go and find a company that is able to make more and more money year after year. If you can find that, chances of you making money is extremely high. If you go for companies that are cheap but losing more and more money year after year, then congratulations. Okay, then you have to pray very, very hard. Hopefully that somebody someday will love this company and buy a lot of it. Okay. Yeah, other than that, keep investing simple. As long as the business is doing better, okay, the earnings go up, naturally the share price should go up. Now over here, you can see that the earnings went up 3 times. So the question over here in everybody's mind is that, but how come the share price actually went up 7.5 times? Right? I mean, if you talk about the share price going, I mean, the earnings went up by 3 times, but shouldn't the share price also go up by 3 times? Why is it 7.5 times? Anybody know the answer? If you know the answer, you can type. If you do not know, maybe you can make some guess. Why do you think the earnings went up 3 times, but yet the share price went up 7.5 times? Okay, y'all can just type something because I realize that when y'all are not typing, I do not know whether you're hang or you're not hanging. Okay, okay, good. I can see the comments coming in. Multiple expansion, fantastic. Okay, what about the rest? What about the rest? Okay, interest, buyback share. There are multiple reasons lah. Right. So let me share with you the answer. Okay, there's actually this thing called the earnings multiplier. Okay, earnings multiplier. This is a formula. So I will make things even easier for all of you. Okay, this is simple mathematics lah. So if you want to calculate the price per share, okay, you will take the earnings per share, multiply by the PE ratio, which is the earnings multiplier. So what happened over here is that the earnings per share of the company, the earnings are just now, as I mentioned, it went up 3 times. But why is it that the price per share actually went up by 7.5 times? Right, it's because the multiplier of these earnings also increases by about 2.5 times. So it's the multiplier effect. So if you have an earnings per share 3 times, multiplier went up 2.5 times, combined together, that gives you your 7.5 times ROI. So how do you actually pick? Okay, now the question over here is, how do you actually pick a company that can give you 100% return? Okay, there's multiple ways. Either the earnings per share of this company double. Okay, that means the earnings per share double 2 times. That means the price also double. If not, if the earnings per share remains the same, you can also purchase it. Okay, and then subsequently the multiplier actually double. That's how the share price will also double. So either one. But I want to ask all of you, which one do you think is easier? Okay, finding the earnings per share that can double or finding the PE ratio that can double? If you think it's earnings per share type E, if you think it's PE ratio type P, which one will be easier to select? In fact, I see to get 100%, right? Not hard because why? You don't even need 1 times. Both increase by 0.5 times. Okay, then you also can get the 100%. Okay, some say PE ratio, some say earnings. Okay, later I will disclose the answer, but I want you all to do some thinking already right now. Okay, very, very important. So this is to show that, okay, I am not bluffing you. The numbers are there. Okay, iFast, September 2018, the PE ratio was 31.4. On December 31st, the PE ratio was 75. So the multiplier actually doubled 2.5 times. Okay, so that's a result of the increase in share price. So again, I hope this is something interesting. So the question over here that some of you will also be wondering, I realize that I'm going quite fast. Okay, because at the pace that I'm going to go through, I think I'll end quite early. Okay, I'll go through a bit slower. Okay, so what causes the earnings multiplier to increase? Maybe y'all can type inside the chat. What do you think will cause the earnings multiplier to increase? So just now we talk about earnings. Earnings is basically when the company do well, when the company, let's say Tesla, sell more car, deliver more car, then of course the earnings year on year will increase. But how to make the multiplier effect increase? I think this is very, very important. Okay, higher projected growth. Wow, very, very fantastic answer by Bungkit. Higher projected growth. Hype. Oh, Bungkit, you go and Google the answer, is it? Okay. Okay, why do I say that? It's because, okay, if you go and Google, okay, these are the two answers that I gotten. Okay, number one is future earnings. Just like what Bungkit mentioned, higher projected growth. So let's say my company, originally my growth is only 10%. I projected to grow at 10%. And then, because of a new technology or a new product, okay, suddenly I forecast that my company is going to grow at 20% every year or 30% every year. So suddenly people see my company more exciting, okay, or rather the future growth is higher. So they give me a higher multiplier. Another reason is this thing called enthusiasm. Enthusiasm, which is also what Bungkit mentioned, okay, in a very layman term called hype. So what do you think is the biggest hype right now? What are some of the company, right? As long as you're invested into this particular industry or this particular segment, the multiplier is crazy. Okay, can somebody just help me to type in which industry right now is the hype? That means the multiplier is crazy. Yes, fantastic. And that is AI. Okay, anything related to AI. That's why you can see NVDA. Wow, the multiplier is a lot. That's why the share price, the earnings maybe go up by about 20, 30% or 40% maximum. But the share price went up 200%. So can you see that? The multiplier went up by at least double or triple. Okay, at the bare minimum. So now you understand this already, right? Then you can start to understand, so how can I, okay, find the next 100% ROI company? Okay, I hope you all start to actually get the sensing. So just like I talk about this thing called enthusiasm, or I talk about this thing called forecast of future earnings. I want to ask you all this question. Is this easy or difficult to forecast? Easy or difficult? Type in the chat. For those of you who are still thinking, okay, help us to also like the button, okay, like the YouTube button, okay, and also share this with your friend, okay. Yeah, help us to like so that, more people can get to see this as well. Okay, thank you so much for all the response, okay. It's difficult, can say not possible to forecast, exactly, okay. Adrian say it's very subjective, it's difficult, exactly. Okay, so today, I'm not going to ask y'all to do the difficult things. I want y'all to do it the easy way. So how to do it the easy way, okay? And that is, instead of trying to predict which are the company that is going to be the next hype, or which company is going to suddenly have an increase in future forecast, all right? What would be easier is to buy great company when the PE ratio is lower than average. So for example, over here, I have got this company, okay, which I'm not going to disclose in case you all go and buy, okay. You can see right now the P ratio, the multiplier is 25. Back in 2021, all the way from 2018 all the way to 2021, you can see that the PE ratio is only at 8. So if let's say you're able to purchase it at 8, and right now it went up to 24, can you help me to type in how much would the share price has gone up at the bare minimum? Assuming that the earnings remains the same, the business no change, everything no change, just that the climate change, people are scared, people are worried, the share price drop, okay, but this company earnings remain the same, but the multiplier drop, okay, multiplier drop, at least 3 times, okay, at least 3 times. So that is something that is really, really amazing. By the way, this company is this company called Meta. Meta. Cannot see clearly, it's blur. Okay, don't worry. You just listen to me. As long as my voice is not blur, then it is fine. Okay, that one more. This is more important. Just in case you want to see me more clearly, let me just put up my face speaker. Okay, just kidding. Okay, yeah, you're not here to see me. You're here to listen. Okay, so very importantly, if you're able to find a great company, okay, again, why I say it's very important to find a great company is because, okay, the assumption is that the earnings of this company never change. All right, the assumption is this. But if let's say there are cases whereby the multiplier drop, but the multiplier dropped because the business is failing. The earnings of the company also drop. In that case, are you buying them at a good price? Then the answer is no. Okay, so you need to make sure that this company is at the bare minimum. The earnings is stable, but because of some bad news, because of the climate, the earnings per share, the P ratio actually dropped. If it dropped by 50%, wow, then congratulations. Because let's say the average this company is trading at a multiplier of 20. And because of certain crises, the multiplier right now is 10. So if you can buy at 10, and then a few years later it recover back to 20, can you see that is already 100% ROI? That means the share price would have doubled. But what is amazing, even more amazing, is if let's say you buy into a company that these few years, not only the multiplier went down, and actually the earnings actually went up. So let's say within these 3 years, the earnings went up by 20%. So you can see that not only do you get that double, you also get the 20%. So then, of course, your increase in share price is going to be even higher as well. So that is why, if possible, go and find a company that is making more and more money year after year. Okay, and then during good opportunity where the multiplier actually drop, then go and grab it. This is easier than trying to forecast. Okay, what is going to, or rather trying to catch all the AI company, etc. Because again, you do not know when is the highest. Like right now, NVIDIA is super, the multiplier is super high. One thing you have to understand also is that this multiplier effect will also come down. Okay, it will come down to an average. So once the hype is over, it comes down. And what does it mean? If the multiplier start to come down, it also means that the share price will start to come down. So again, that is also one of the reasons why we try not to chase after all the high multiplier stock, or rather the hype stock. Again, it's just because we do not know whether are you the last person or not. So for those of you who love to, who fall into some of the Ponzi scheme, again, they always tell you, don't be the last one. If you don't be the last one, you go in, you exit at a higher price, make more money, make some money, and then you get out. Okay, that is the best case scenario. But the problem is you do not know when is the highest. Okay, and the worst thing that can happen is that at the start you make money. Then after that, you go and put in even more money. And when you put in even more money, then the whole thing crash. And then you lose a lot of money. Okay, so that is not uncommon. So if you find this familiar, can you type in F in the chat? F for familiar. Okay, that means you buy, you make money, you can buy even more, and then after that, it crash. I think 2020, a lot of people fall into this. Okay, especially like the Wall Street bet or some of the tech company in the past. Yes, thank you so much for being so honest. I think some of you are already typing in F. Okay, let's move on. So I want you to look at this particular company. So this company is called Microsoft. I want you to assume if you bought Microsoft in 2022 at PE 25. Okay, at PE 25, you can see where is 2022. At PE 25. And the earnings remain unchanged. How much would the share price has gone up? You can see the current multiplier is at 33, but you bought it at multiplier of 25. Assuming the earnings remains the same, how much would you have made? Can you help me to type in the answer? Just use your calculator and roughly calculate. You will be able to get the correct answer. Okay, so you bought in 25 at multiplier 25, and current multiplier is 33.95. Okay, I think somebody already typed in the answer. 1.3 times. Yes, exactly. Okay, it will be about 30%. So if you take the math, 25 go up to 33. Okay, so technically, the share price should go up 31%. However, if you look at Microsoft, did Microsoft share went up 31%? The answer is no. Okay, Microsoft share actually went up by 42%. Okay, another 10% more. And why is that so? Okay, why is that so? Why did Microsoft went up more than 31%, even though the multiplier only went up by 31%? Okay, I think you all know the answer is because, okay, the company earnings went up over the last few years as well. Okay, so that is something that is very, very important. So that's very important. So that is why Warren Buffett actually mentioned this thing. It's far better to buy a wonderful company at a fair price then a fair company at a wonderful price. Okay, this one, I want you guys to really go and digest it for about 10 seconds. Okay, I want you to digest it for about 10 seconds because there is a very important learning lesson over here. It's far better to buy a wonderful company at fair price than a fair company at a wonderful price. Okay, give you about 3 more seconds to think about it. Okay, 3, 2, 1. Why do I say this is extremely important? If we just look at the second part of this sentence, a fair company at a wonderful price. So what it means is that, let's say the multiplier of this company drops significantly. Okay, that means the share price drops significantly. Okay, and then you go and see the multiplier like, hey, wow, right now, this company is undervalued. I think it is a good time for us to buy in. For example, I think Intel is one of the case study. Okay, Intel used to be trading at a higher multiplier, but then, if you look at the multiplier right now, it's super attractive. So some of us will be wondering, wow, I think Borwen, this is an attractive price right now. Is it time for us to go in? Then we look at the company. Is this a wonderful company or is this a fair company? I'm not saying that Intel is a lousy company. Like I said, it is a decent company. However, if we just go to the basic fundamental of a wonderful company is all the numbers or all the metrics should be increasing. That means the earnings should be increasing, the return on equity should be increasing. Okay, the net income should be also pretty healthy. All right, now of course there's other things like the debt level must be relatively low, the cash flow must be relatively strong as well. So of course there is a definition between a wonderful company versus a fair company. But what happens is that if you find something that is cheap and then you go and buy it, the worst thing that can happen is that, like I said, the business is actually failing. So as the business is failing, you thought it's cheap, but the problem is cheap can become cheaper. So that's something that we want to avoid. So why Warren Buffett say it's better to buy a wonderful company at a fair price is because assuming that right now there's this amazing company, okay, the earnings is growing at 30% every single year. So let's say this year the earnings per share is 1, next year is 1.3, then the following year is 1.7. Okay, it's increasing by 30% year on year. Okay, but the price is not the cheapest but it's fair price. That means you're not buying at a lower multiplier. You're not buying at a very low PE ratio. But you have to understand if the company earnings is growing by 30% year on year, so which means that year 1 is making 1. The earnings per share is 1. Year 2 is 1.3. 1 to 1.3, then become 1.7, then become 2 point something. So can you see, just by investing in a company that is growing at about 30% year on year, how long does it take for you to double your money? Assuming that the multiplier remain the same. If it takes this company 3 years to double up the earnings, which also means that based on the same multiplier, the company share price will also double in these 3 years. Can you understand? If you understand, type U. If you understand, type U. So that is also why one of the key thing, right, that we want to look at, if you really want your portfolio to grow, if you want to find the next 100% company, should you invest in a company that is growing at 5%, or should you invest in a company that is growing at more than 20%? Which one? 5%, but it's cheap or 20%, but the valuation is not very cheap, but it's fair. It's fair price. A or B? 5% or 20%? Okay, definitely we want to go for the 20%. Because why? Like I said, even if it is not the cheapest, okay, it is a fair price, but because the earnings is growing by 20% year on year. So which also means that maybe it will take you about 4 years to 5 years and you can double your money. If you ask me 5 years to double money, is it good or not? According to the rule of 72, 5 years to double my money means that every year my return is 14%, which I think is pretty decent, 14%. Okay, yeah. So of course, if you can find a company that is at fair value and is growing at 30% year on year, then congratulations, because it will probably take you about 2 to 3 years. And we also understand that, okay, certain company, if you buy it before the hype happen, and then maybe along the way, there'll be a hype about it. Okay, people start to jump in. And then not only the earnings went up, the multiplier also went up. That's where you can get to see a very, very huge, drastic increase in your share price. But that's also the reason. Sometimes when the multiplier is so high, one thing that I like to do, for example, if I'm an NVIDIA shareholder, I look at the current multiplier. I know that this is a great company, but I also know that the multiplier, right, at some point of the time, it will start to come down. What I can do is I can actually take out some of the profit. Again, I still believe in this company in the long run. I do not want to totally get out of the market, but what I can do is I can actually maybe just take out 50% of my holding. So I get to, collect some of this super high multiplier. Okay, I get to reap the reward first lah. Then of course, subsequently, if it goes up higher, do I get to lose? No, I still have the other 50% that continue to go up even more. I still make more money. But in the event, if it comes down to the average, then of course you can see that you can actually reinvest all this money into other great company that is at a wonderful price as well. All right. So I hope today's sharing, right, okay, you all get to really understand that really to find the next 100% company, it is not about being lucky. It is not about, the right timing. Of course, the timing does matters to a certain extent. Okay, but I think very importantly is if you're buying into a lousy company, your risk is very, very, very high. To me, it's gambling lah. Okay, maybe if it goes up because of certain thing, then it's luck. It is not really a skill. All right, so you want to find a business that is generating, for me, at least 15% growth rate in terms of the earnings year on year. Okay, every year is growing by at least 15%, 15%, 15%. So maybe it will double in about 5 to 6 years. All right, then of course I also want to make sure that I don't buy at a super high valuation. That's also something that I just want to make sure. So how do I know whether is it a super high valuation? I think one thing we can look at is the multiplier. Just now I look at, just now if I were to reference back to the Microsoft, okay, you can compare to the 5-year average lah. Okay, y'all can see over here, right? Over here, somewhere around in the, let me see if I can have a pen now. Okay, cannot. Okay, yeah, just beside the 2022, beside the current, there's a 5-year. So you just want to make sure that you buy below the 5-year average lah. So if you're able to buy 20% below the 5-year average, then congratulations, you already have a hidden 20% upside that you can actually unlock when the multiplier starts to go back to normal. All right, so to me this is a bonus. If you can get it at a good price, congratulations. But to me, even if you find a great company but it is fair price, I think it is actually still worth going into as well. Because why? The company do well year on year, the share price will also continue to go up. Just make sure that you don't overpay for it. Did y'all learn something from today's session? All right, I hope y'all do. Okay, anyway, today, really, I just want to share with you this powerful concept. So if y'all have any question, okay, if you have any question or any company that you want me to take a look, now is the time. Y'all can put inside the chat. Which is a wonderful company in Vietnam? Okay, wow, I love this question. Okay, because this is a very amazing question. Okay, stop sharing. Okay. Let me just go through one by one. Let me go through one by one. Okay, continue to keep the question coming. Continue to keep the question coming. Then I can actually go through and share with all of you. Okay, I need to share my screen first. Share. Okay, so first, let's look at this question. Which is a wonderful company in Vietnam? Okay, so for me, okay, obviously I don't have the Vietnam. I'm not from Vietnam. Okay, yeah. But I can speak a bit of Vietnamese. Okay, but that's not the key point. So how do I look for Vietnam stock? Okay, for overseas stock, I can use this company called Jita. Okay, so I'll just log in. Okay, it's totally free. Y'all can see over here we have Vietnam. Okay, amazing. So again, very simple. This is a reference to help you to look for company. So if you totally do not know, then at least you go and find a company that is higher in scoring lah. So for example, this company called, this company called Military Commercial something one. Okay. It's called VNM. MBB. Oh, this is a bank. Okay. Okay, maybe don't choose a bank. Bank a bit more challenging. Okay. Let's go for something that we all are familiar. Let me see if there's anything that's familiar. Dun, 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 dun. Okay, obviously I'm not familiar with Vietnam. Okay, or I don't understand. Okay. Wow, really, all I don't understand. Okay lah, let's just go back lah. Okay, so this company is called MBB, Military Commercial Bank. Okay, so if this is a well-known bank in Vietnam, maybe Nhung Chi Tan, you can let me know. Yes or no? Is this a well-known bank? So of course, I want to look for the information of this company lah. So I can just type in MBB Vietnam Morningstar. Okay lah. The challenging part is where do I get all the financial statement? Okay, I hope they have it over here. Okay, let me just go and take a look. Okay, wow, only got a few years of data. Okay, so you can see, let's just look at the revenue lah. Okay, revenue of this business. Okay, I zoom in for y'all to see. So y'all can see clear. Cannot. Y'all can see, right? Very big. Revenue, is it increasing? 2022, 2020, all the way until today. Is it increasing? It is lah. Okay, so not bad. Then we look at the earnings. Okay, the earnings per share. Is it increasing year on year? 2020, 2021, 2022. So again, you can see from 2020 all the way to 2022, right? This company earnings has already doubled. So assuming that the multiplier didn't change, can you see that by right, this company, the share price should also double? Okay, so of course, we go back to 2020. If you bought it at that point of time, what is the multiplier? Okay, so this is the exciting part. Okay, wait, let me just scroll to 2020. And I show you. Okay, so if you look at 2020, the multiplier is at 7. Okay, which is actually about fair price. Can you see it's about fair price? Because the fair price is about 7.3. So at the point of time, it's about 7.2. So you know that, this is a fair price company back in 2020. Then of course, right now very low. 5.26. So now it's under value. Okay. So of course, like I said, if you look at the share price 2020 until today, I believe that the share price has still gone up because why? The earnings has gone up double. Even though the multiplier has dropped by maybe about 20%, okay, but the company earnings has gone up 100%. So let's look at the chart. So this is the example you bought it at a fair price, okay, but then this is a wonderful company. You cannot see from here. Okay, let me see if I can find it. MBB share price. Not this one. MBB Vietnam share price. Okay, I just now can see. Okay, so you can see 2020, the share price is about, about 7,284. Okay, right now it's about 18,000. So it's still about double more than double. Okay, more than double. So you can see that's the power when you're able to pick a great company that the earnings is increasing drastically, even though the multiplier is remain the same or it went down slightly. Okay, wow, you will still make pretty good income. Of course, the best is you buy under value and you buy a high growth company that will be the perfect. Okay, so this is for this Vietnam company. Okay, again, I hope this help you guys. Okay, so that if you all go for any other company like Japan company, if you all want to go for Hong Kong company, can you do the same thing? The answer is the same Okay, anywhere. Let's look at this. Okay, one of our Facebook user, Love RCL. I'm not sure who are you. Okay, but let's take a look at RCL. Okay, so this one I can just go to, okay, this is a US based company. So a bit easier. I use my usual website. So RCL. Royal Caribbean Cruise. Let's take a look. at the financial. Okay, just try to zoom in for you guys. So you can see pre-COVID. Wow, I love this company pre-COVID. Okay, you can see it's increasing. Can see increasing, right? And then boom, COVID come, cannot go up for holiday. It went down. 2021 continued to do badly. Okay, but right now it's recovering. So right now the revenue is back to 2016, 2017. Okay, but let's look at the profit lah. The profit will definitely have a big impact. As you can see over here, okay, why is it that revenue remains the same? That means the revenue has already gone back to pre-COVID. But why is it that the net income is negative? Anybody want to make a guess? That means the revenue went back to pre-COVID 2018. But how come the company never make the same amount? Okay, very simple lah. You can see that the expenses went up significantly. Okay, not only the expenses went up significantly. Okay, this is operating expenses. Okay, but of course we also have the interest lah. Because if you know the cruise line, right, majority of the money actually is on debt one. That means they have quite a fair bit of debt lah. So right now the interest rate is super high. So they are paying extremely high amount of interest. That's number one. And also number two, after COVID happened, do you think there's more staff or less staff? The answer is definitely more staff. Because why? Everybody need to take care of the hygiene. In the past, you can pack 500 people in this room. But right in this ballroom, for example. But post-COVID, there's a limitation. Only 50 people, only 100 people, only 200 people. And you need to have more people to make sure that, people have taken their COVID test and etc. So the expenses generally has gone up. But I think the good thing is now everything kind of normalized. Okay, normalized. But it still take a bit of time. The impact is still very big, especially on the interest portion. So coming back to Warren Buffett's statement, is this a wonderful company or is this a fair company? Okay, I think it's a fair company, or maybe it might be slightly even less than a fair company. Okay, yeah. So do I even need to want to look at the valuation? Okay, this is the example lah. Maybe it might be cheap. Maybe I do not know. Okay, but we can take a look at whether is it cheap or expensive lah. You can see I can't even tell the cheap or expensive because why? This company is losing money. When the company is losing money, there's no multiplier of the earnings. Okay, it's going to be negative. So again, there's no way we can actually gauge for this particular company. So for me, number one, if the company is losing money, right, don't even look at it. Okay, wait for everything to stabilize. Or go and look for a growing company that is profitable. Again, that's to reduce your risk. Okay, I love this question. Any pharma company with good PE ratio to recommend? Okay, for me, very simple. This is my own personal view. I tend to avoid pharmaceutical company. Why do I say that? It's because I used to come from pharma background. Okay, I used to study science in school. So I always love science company. When I first started my investment, okay, I also started by looking at pharmaceutical company. They have always given me the best financial, everything perfect one, everything, revenue go up, earnings go up, everything go up. Okay, but one thing that I realized is that pharmaceutical company, right, the share price tend to be very volatile. Wow, suddenly you go up a lot and then suddenly it drop like crazy, and then it go up a lot and then it goes down crazy. So that is where I realized, okay, what is very important about all these pharmaceutical company or biotechnology company or research company is that they depend a lot on patent. So every time they have a new drug that is potentially at stage 2, stage 3, then the share price, the hype become very hype lah. Then the share price will go up significantly. Then after that, they fail at stage 4, and then the share price will come down like crazy. So there's too much of this fluctuation. So that is also something that I don't really enjoy lah. Okay, investing into pharmaceutical company, right? And I remember previously, right, when I just started investing, there was one company, pharmaceutical company doing extremely well. Now I also forgot the company, but the numbers were so amazing, okay, that I cannot believe that there's actually such a good deal. But of course, when you actually go and dig deeper, right, you will realize one thing. Because why? This particular company has created a patent for cancer drug. Okay, it's actually one of a very, very powerful patent for cancer drug. So because of this patent, this company make massive amount of profit. Okay, massive amount of profit. But what happened is that patent don't last forever. Patent lasts for on average maybe about 12 years. So when I was looking at this particular company, right, it was at about 10 years of this patent. So if you really go and read carefully at all the annual report, right, you will know that in 2 years time, this company majority 90% of the profit just come from this one single patent. So which also means that 2 years later, everything will drop. So what happened? Actually, the investor also not stupid lah. Okay, some investor they know that's why the share price has been dropping. That's why it seems to be of a bargain. Okay, but of course there will still be investors who do not know lah. They see this as a good company, as a good as a hidden gem. They go and buy it. The moment they announce that their patent is over, the share price drop by over 70 to 80%. And then it continue to drop from there. Because technically this company has got no value lah if that patent is no longer valid. So that is something that we have to understand. We have to read a lot lah. So if you want to read a lot, you want to understand a lot, then you can look at pharmaceutical company. Oh, okay. Let me just look at some other question. Thank you so much. Yes. High R&D cost and patent issue. Exactly. Hi, Borwen. Could you do a stock analysis on DHR? Okay, before that, I need to understand what is DHR first. Wow, interesting. I never heard of this company before. Even better lah, so I can be more. Okay, let's take a look at this company. Again, I've never seen this company before. I just look at the number. Okay, so number looks pretty decent. 16, 17, 22, 29, 31, increasing lah. Okay. But you can see that the growth is also up and down. Some year they go up like 5-6%, some year they go up 20-30%. Okay, but generally, okay, let's look at the income. Okay, let's look at the income. Income is increasing over the years. Okay, something is wrong over here. Okay, y'all can see. Sorry, this is income tax. Okay, sorry. Okay, let's look at the income. Yes, income is increasing. Okay, good. Okay, so revenue pass, earning pass. Okay, then of course we can go and dig even further lah. So for example, you want to look at the net margin. I like to look at the profit margin. Is the margin increasing? From 15, it went up to 21. Now it's 22. Wow, also pretty decent. Free cash flow is also increasing. Pretty fantastic. Okay, so overall, just a quick view of the numbers. I think this looks pretty promising. Okay, this looks pretty promising. Then of course, let's take a look at the ratio. Okay, the P ratio of this company used to be at 25, 27, 37. Okay, so if you just take the average lah, okay, y'all can help me type in what do you think is the average P ratio of this. Okay, I would say somewhere around 30 plus. Okay, agak lah. Okay, this one again there's no perfect or correct answer. So around 30 plus. So I think at the current pricing is pretty fair value. Okay, pretty fair value. So if they are able to grow at a 20% to 30%, then of course you can kind of forecast that the share price will increase by about 20 to 30%. Okay, that is for this particular company. But of course, if you're able to buy it somewhere around 20 plus, wow, I think good even better. Okay, because why? You can see that at a certain point of time it can go up to about 40. So if you, let's say you buy it about 25, okay, and then it went all the way to even 35. So 25 to 35, that is really about 30% increase in the multiplier effect. Not to say this company is still growing. So that is where you can get to right on both sides. The multiplier went up, then of course the earnings also gone up as well. Or is it 35? Some of you put 35. Okay, maybe my math fail. I just take a quick calculation. Let me just calculate. 27 plus 37.5 plus 45 plus 37.5 plus 27. I divided by 5. Actually, I write around 34.5. Okay, so right now I think it's slightly below the fair price. Wait, so I mean pretty decent. But for me, I want to understand this business a little bit more. Okay, I want to understand this business a little bit more. One thing that I just a bit more concerned is the revenue seems to be slowing down. Okay, I mean anything like I said just now I want to look at revenue and earnings at least 15% year on year. So for me, this one less than 15%. Then I have to go and dig a little bit further. Is it this year only? Maybe next year they will do 20%, 30% like the year before. If that's the case, then good lah. Okay, this one. Okay, okay, so I think I covered this. Any other question? Okay, I think there's one very long question. What if after multiplier is 113 and the current price is lower than that? Well, this one I don't know. Like John 1, do you have the company or not? Maybe if you have the company, I can better understand because I don't really understand this question. What if after multiplier is 113 and the current price is lower than that? 20%. Okay, don't understand. Okay. Okay, any other question? Maybe we'll just take about one more question. Okay, before we end off today's session. I think right now the number is dropping. Okay, wait, y'all don't go first lah. Okay, still got one final question. Okay, anyway, while waiting for the final question, okay, if you guys, let me just remove this first lah. Okay, before we take the last question, if you guys like what you are listening, okay, and you want to know a structured method to analyze company, to look at valuation, to find the next solid company, okay, the best place, okay, y'all know, some of you already know. Okay, this one I need to do some promotion a little bit. Okay, this one is really undervalued one. This one is really undervalued. Okay, and that is, wow, where is that? I think it's this one. Wow, okay, yes. Okay, yes, please do join our 2-day BOS MBA for free. Okay, like I said, this one really, I cannot even use valuation to valuate because why? It's free. Okay, but of course, I also understand one thing. Okay, to me, nothing is free lah. Nothing is free in this world. Okay, what you are paying for it, right, is your time. So I just need you to invest your Saturday and your Sunday for this. Okay, but I can tell you, the thing that you receive over there is going to be full of value. All right, so it's not going to be Saturday and Sunday. It's not going to be wasting your time lah. So if you want something that's structured, you just started investing, you want to know how to do it correctly, you want to avoid losing money in the future, then this is the place that you need to go. Okay, so again, let's help your friend also. So if you have friends who are investing, okay, get them to join in together with you. Then of course you don't tell them it's free lah. You charge them $20 also can. But this one you collect and don't tell us. Okay, fantastic. Okay, so let me just remove this already. Okay, advertisement is over. Let me just look at the last few company. Do you think the aviation company like Singapore Airlines is a good company? Okay, for me, I tend to avoid airline company because number one, a few things. Okay, number one, it is highly affected by oil price. So if the oil price go up, airline profit will drop. So that's something that we have to understand. And of course, to operate an airline business, especially like Singapore Airline, the costing is not low. Okay, they are capex, we call it capex. Okay, capital expenditure to buy new plane, to upgrade the plane, to refurnish the plane. All this costs a lot of money. So again, the risk is relatively higher. I want something that is lower risk one. Okay, easier to make money one. I would say Singapore Airlines, not say they cannot make money but harder to make money. How many stocks do you recommend to hold in the portfolio for long-term investing? Okay, that depends on how much you can absorb. Okay, so again, I think if you reference my mentor, okay, Pete, some of you have seen him before. So for him, he has been investing for many years. He likes to look at report. Every day he got nothing to do. He look at report. Okay, so for him, he can go for maybe about 15 companies. 15. So again, this 15 company that he's invested, he's very familiar with them. If you just started, then of course, I would say that maybe start with around 5. So again, go for 5 that you're familiar with it. That means you eat, sleep, breathe, you understand this company. Whenever you see any news, you know exactly what this news is referring to in this particular business. If you can't do that, then don't go for those 10, 15. I think you won't be able to absorb so many things. Okay, since it is undervalued and earnings after pandemic is growing, again, look at the earnings. Okay, for me, is the earnings able to catch back or even do better than pre-COVID? For me, that is the key concern. All right. Can please send another link? Okay, the link is not working. Rebrand.ly/BOSMBA free. Okay, I believe that's the link. Okay, you can refer to the link at the flowing one. Then here, over here. Can refer to the link. Okay, Palo Alto Network. Okay, this is the last company, and then we are going to wrap up, okay, today's session. So allow me to share my screen now. Okay, Palo Alto Network. Okay. Why I choose this is because this company looks familiar. Okay, but anyway, let's take a look at the numbers. Okay, so if you look at the numbers in terms of revenue, pretty amazing. Okay, consistently around 20% growth. Then of course, if you look at the operating income, okay, let's look at the income. Net income. Okay, you can see what they used to lose money one. Okay, then of course, right now they are profitable. Okay, they just turned profitable. Wow, pretty interesting. Okay, just turned profitable. Let's look at the margin, net margin. Okay, so their net margin is about 6%, which is still pretty decent. Okay, of course, because they just started to turn profitable, so their margin probably will increase along the year. So if they can go for 10% or more, I think that will be even better. Okay, again, this is for this Facebook user to take note. But overall, I think it is pretty decent. I mean, considering that they just turned from losing money to profitable, I think to get 6% is pretty decent. Let's look at consistency. Are they able to do it year after year as well? Okay, cash flow, everything is also pretty decent. Okay, so let's just take a look at the. Okay, again, this is just analysis based on number. So again, if you look at investing, there's always two parts. One is the qualitative part, one is the quantitative part. So right now, I'm just looking at the quantitative, looking at the number. The quality of this company, like the management, what are they doing? The business, what is the mode? All this I do not know, okay? Unless I go and read out even further. Okay, let's look at the PE ratio. Okay, so again, this one a bit hard to gauge because why? It used to be losing money, so losing money, you can't really tell. Okay, so of course you can see right now because they just turned profitable. So the multiplier is going to be very, very high. All right, so you can see that the PE ratio is at 189. In this case, maybe another thing that you can take note is instead of comparing the PE ratio, you can look at the PB ratio, price to book ratio. Again, we can look at the 5-year average. Okay, you can look at the 5-year average. So if I were to take the 5-year average, okay, considering very importantly, anything that you see like extremely high, this is what we call outlier. Okay, this one you have to avoid as well. Okay, usually for outlier, I will tend to avoid as well. All right, so if I were to exclude this and I just take the average of 2023, 2021, 2022, 2029, and 2018, I would say that the average is maybe somewhere around 30. Is it? I mean, let me just calculate. 41. 43 plus 61 plus 22 plus 13 plus 15 divided by 5. Okay, it's about 30. So right now, the price to book is at 43. So which also means that it tend to be a little bit overvalued. All right, so I think the numbers, everything looks pretty amazing. But of course, we can wait for this company to kind of settle down in terms of the valuation. Right, I don't think it is at really, really like a no-brainer kind of valuation to go in. Of course, there are a lot of things that I look at. Of course, one of the things that I look at is the trend. Okay, the trend of this particular company as well. If the trend is going up, then of course, it is a different story. Okay, so that is what I have. I hope that answer all of your queries. Okay, so anyway, it is not over because next week there'll be even more amazing speakers. So next week, Chloe will be back. So if you guys want to catch Chloe, okay, do join us next Tuesday at 8 p.m. Okay, basically just put into your calendar. Every Tuesday, 8 p.m. I must join on our YouTube. Okay, because we have a lot more exciting things to share with you. Of course, if you want to be able to also share with us more about what are the topic that you're looking out for, okay, you can join our Telegram as well. Okay, join our Telegram, BOS Telegram. Then of course you can also let us know, all right, what are some of the content that you guys are interested in so that we can actually come up with even better and even more exciting, okay, content every single week. We try to keep it exciting and we try to keep it as engaging as possible. All right, with that comes to the end of my session today. I hope you guys have learned a lot from today's session. Once again, don't forget to help us to like and share this video out so that we can reach out to more people. All right, and we'll see you guys, okay, at 8 p.m. next Tuesday. Take care and bye-bye.